Welcome. In this video, can Zbcn coin do 180% and make a new ATH? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When we look at a financial chart, we usually see that the price moves in a certain direction and then forms some lines or channels that limit this movement. One of these lines is the descending trend line. The descending trend line shows that the price is making lower highs over time, following a downward trajectory. In other words, whenever the price attempts to rise, it stops below its previous level and then continues its downward move. This indicates that sellers are strong in the market while buyers cannot show enough strength to keep the price up. That's why a descending trend symbolizes that the market is under pressure and constantly in a downward psychology. However, there is a very important point in technical analysis. No trend lasts forever. The descending trend also eventually weakens, fades, and can be broken when buyers step in. If the price breaks above this descending trend line, that's when a major shift in market psychology occurs, because most investors see this breakout as the beginning of a new rally. The breakout of the descending trend is critical not only in terms of price movement, but also in terms of the emotional state of market participants. For a long time, a constantly suppressed price creates hopelessness, impatience, and distrust among investors. Every time a rally attempt is met with selling at lower levels, buyers lose confidence. But one day comes when the price manages to break above this line. At that moment, a new hope is born in the market. Investors who previously kept selling during declines now hesitate. The question arises, is the trend reversing? For many technical analysts, breaking the descending trend means that the selling pressure has ended and the door to an uptrend has opened. If this breakout happens with volume support, that is, if trading volume increases while the price rises, then the signal is interpreted much more strongly. Because higher volume shows that buyers are truly entering the market and that the move could be sustainable. With the price breaking the descending trend, it is often said that a rally has begun. Starting a rally doesn't just mean a few candles of price rise, but the formation of a new direction in a broader perspective. Because the descending trend line has acted like a wall, pushing the price down every time. When that wall breaks, the biggest obstacle in front of the price is removed. Investors now believe the price can aim for higher levels. This leads to new buying activity in the market. Especially short-term sellers, who kept pushing the price down during the descending trend, now turn to buying in order to close their positions at the breakout. This often triggers a rapid price increase. That's why trend breakouts are considered the beginning of a rally in technical analysis. After the descending trend is broken, the price usually makes a strong initial jump. But this jump does not always continue in a straight upward line. Sometimes the price retests the broken trend line. In other words, right after the breakout, it pulls back to touch the same line and then continues to rise again. This is known in technical analysis as a pullback. A pullback is basically investors' way of seeking confirmation. If the price returns to the broken line and finds support there, it confirms that the breakout is real, not fake. This builds more confidence and attracts more investors into the rally. Therefore, breaking the descending trend is not only a technical move, but also a psychological turning point. With the rally starting, the price begins to make higher highs and higher lows. This signals the birth of an uptrend. Breaking the descending trend thus symbolizes the start of a new upward trend. Especially if this breakout comes after a long downtrend, market participants see it as a major reversal signal. Because everyone knows that long declines eventually end somewhere, and the market changes direction. The first sign of this shift is the break of the descending trend. At the same time, as the price rises quickly after the breakout, investors feel the fear of missing out. The higher the price goes, the more people want to jump in. This increases buying and strengthens the continuation of the uptrend. A descending trend breakout can also be the beginning of technical formations. For example, after breaking the descending trend, the price may form reversal patterns like an inverted head and shoulders or a cup and handle, which are bullish signals. This strengthens the rally even further because technical formations give investors target levels. These targets usually help predict how far the price could rise after the breakout. So the trend breakout is only the beginning. It can open the door to much stronger moves. One key point investors should watch during such breakouts is their sustainability. A price might temporarily cross above a trend line, but then quickly fall back again. In this case, the breakout is false. Such moves are often called false breakouts and can mislead investors. However, in a true breakout, the price no longer stays below the trend line, but above it. This shows that the rally is built on solid ground. Increasing trading volume, rising momentum indicators, and growing investor confidence all confirm this process. In conclusion, the descending trend line symbolizes that the price is constantly under pressure and following a downward course, while breaking above this line signals the beginning of a new rally. The breakout moment is a critical turning point both technically and psychologically. When investors see this breakout, they believe that selling pressure has ended and an uptrend has begun. This belief triggers new buying activity and pushes the price higher quickly. That's why the phrase, "First there is such a descending trend, and if the price breaks it, a rally begins," is a very meaningful and accurate observation in technical analysis. Because every trend eventually ends, and the moment it breaks, it gives the market a new direction. The rally that starts with the descending trend breakout offers investors new opportunities and signals that the price could reach higher levels in the future. But we can't make decisions based on only trends, so let's take a look at the other metrics as well. Keep watching.
The line you marked actually represents the peak point that the price formed in the past, in other words, the previous ATH, the all-time high, and this level represents a zone of great psychological importance for investors. Because once the price reaches this level, we see that no one has bought at a higher point before, and this actually creates one of the strongest resistance areas in the market. While many investors prefer to take profit when this level is reached, at the same time, new investors start asking themselves the question, can this level really be broken? If the price has stayed below this level for a long time, tested it several times and pulled back each time, the psychological weight of this line increases even more. However, once the price breaks this line, the old peak, with strong and high volume, then the perception in the market completely changes. Because now the price has entered a new discovery area, moving toward price zones never seen before, and this strengthens the perception in the eyes of investors that the price is now moving forward without any obstacles. This breakout gives a very strong message to the market not only in a technical sense, but also psychologically. Because among investors, there are often expectations like the previous peak cannot be broken, or selling pressure will come from here. That's why the breaking of this level actually removes doubts in the market and increases investor confidence. Especially when an asset that has remained below that level for a long time finally breaks this barrier, a new wave of strength comes into the market. This wave of strength comes both from investors who follow technical analysis and from those who only focus on price movement. Because people usually perceive the appearance of a new peak as a very positive development and believe that the price will continue to rise afterwards. This increases the number of buyers and pushes the price to move further upward. In addition, during these kinds of breakouts, volume usually rises well above normal. This means the price not only breaks the line, but also convinces market participants, gaining upward momentum. At this point, the feeling called FOMO comes into play, fear of missing out. Investors who were previously hesitant to buy at the old peak, when they see the breakout, say, "I don't want to miss out anymore," and enter the market. This allows the price to stay above the broken level and strengthen further. Thus, the price not only breaks an ATH, but also increases its momentum to build new peaks above it. This situation leads investors not to suppress the price with profit-taking, but instead to make new purchases, allowing the uptrend to continue in a healthier way. Moreover, the breaking of the old peak causes that level to stop being a resistance and turn into a strong support. In other words, even if the price pulls back to that level later, this point that once acted as resistance is now seen by investors as a buying opportunity. That's why after such breakouts, the price not only accelerates its progress, but also sits on a stronger foundation. Because one of the main reasons the price continues moving upward is this: there is now a support level behind it that investors can look at with confidence. New peak levels actually make it difficult to predict in advance how high the price can go, because in technical analysis, interpretations are usually made based on past price movements, but in new peaks, since there is no such past reference, the price progresses completely based on investor psychology and the strength of market demand. This often causes the price to rise much faster and more aggressively than expected. Especially in bull markets, these kinds of breakouts trigger chain reactions. Investors who see the first breakout buy in. As the price rises, more investors gain courage, and this process almost cumulatively carries the price to new peaks. During this process, technical indicators also generally support the rise. For example, the RSI indicator usually moves toward the overbought zone, but the momentum of the price allows this to continue for a while longer. Trend-following indicators like MACD generate strong upward signals. Moving averages line up under the price almost like a staircase supporting the rise. The harmony of all these technical indicators helps investors gain more confidence and helps the price advance rapidly.
A flag formation is one of the most trusted patterns in technical analysis and is especially used by investors to understand whether price movements will continue in the direction of the trend. The main logic of this formation is that after a strong upward movement, the price enters a consolidation period within a narrow range, usually moving downward or sideways, and then breaks upward again from this tightening zone. In fact, this structure is a technical signal showing that large investors or market makers are realizing short-term profits, but in the medium and long term, the trend direction is still strongly upward. In other words, the flag formation is a reliable continuation pattern that indicates the trend will continue, and when interpreted correctly, it can offer the investor high profit opportunities. The first striking thing in the formation of this pattern is the sharp upward wave. This wave can be thought of as the pole of a flag. This rapid rise in front of investors shows that the market is under strong buying pressure and that prices are being pushed upward with certain momentum. Then, the price starts to pull back or tighten sideways for a while. This stage is defined as the flag itself. This pullback is usually not very deep because market participants still believe in the uptrend. It is more like a pause, a breathing process. In this narrow area, the price usually moves within a downward sloping channel. This image looks just like a flag waving in the wind. That is why it is called a flag formation. The most critical point of the formation is which direction the price will break from this tightening structure. In most cases, the flag formation breaks in the direction of the existing trend, that is, upward. When this breakout occurs, the target of the formation is a new rise equal to the height of the flagpole. In other words, when the price breaks upward, the subsequent rise is calculated to be as much as the initial sharp upward wave. In the situation you mentioned, if the price breaks the upper line, there is a possibility of a rise equal to the height of the pole, and this rise indicates a remarkable increase of around 180%. This 180% potential rise shows how powerful the flag formation can be. Because the most important thing for investors is the risk-reward balance. If the target, in case of the formation working, points to such a high return, it whets the appetite of investors. Especially large investors, funds, and professional traders pay attention to such technical structures to plan their positions, because the target of a formation is not only a price forecast, but also reflects investor psychology. When people are convinced that the price will rise further, buying increases, creating a self-feeding process that actually pushes the price upward. Another important point underlying the success of the flag formation is volume. Usually, during the pole part, trading volume is very high. In other words, the rise occurs strongly and with high volume. Then, while the price consolidates in a narrow area during the flag part, the volume decreases. This decline shows not that buyers have completely withdrawn from the market, but that they have entered a short-term resting period. Finally, when the price breaks the upper line and starts moving upward again, volume increases once more. This is a sign of how strong and reliable the breakout is. If this process works properly, the probability of the price reaching the target is very high. Now, let's detail this 180% rise a bit more. Let's say the price rose rapidly along the flagpole and then formed the flag formation. If the length of the pole was, for example, formed by a 90% increase, the same rise rate is targeted again with the breakout of the formation. This makes a total rise of 180% possible. In other words, the price both rises from the current level and is seen as highly likely to reach this target in the eyes of investors. Therefore, the flag formation is an important signal not only for determining the short-term, but also the medium-term trend. In such a scenario, investor psychology also plays a very important role, because when the price breaks the upper line, this breakout is perceived as a confirmation signal. Investors buy with the thought, now the rise has started. These purchases push the price higher. Meanwhile, those who are late to take positions also turn to buying to avoid missing the price. That is when FOMO kicks in. This psychological effect also increases the speed of the rise. That is why the flag formation is a strong structure not only technically, but also in terms of market psychology. Another factor that increases the reliability of the flag formation is the general direction of the trend. If the market is already in a long-term uptrend, the likelihood of such formations working successfully is much higher, because when the general tendency points upward, small pullbacks are only corrective moves. In other words, the big picture trend does not change. In this case, the movement that begins with the breakout of the flag formation can be seen as a natural continuation of the trend. Institutional investors in particular evaluate such trend continuation formations as opportunities. As a result, the price breaking the upper line in the flag formation can trigger a new rise equal to the height of the pole, and this offers an extraordinary potential increase of around 180%. This is one of the most exciting aspects of technical analysis, because it is possible to form opinions about possible future movements just by looking at shapes on the chart. Of course, no formation gives 100% guarantee, but the flag formation is a structure considered quite strong both in theory and practice. A breakout that occurs with proper volume support gives investors high confidence, and the targeted large upward move is achieved successfully most of the time. Thus, the flag formation is a unique tool both in determining price targets and in helping investors understand market psychology. This new wave that begins with the breakout of the upper line once again reveals the strength of the market and shows that the trend is still standing tall. For the investor, this is not just a formation, but also a great opportunity, because in such technical structures, taking the right position at the right time leads to exponential growth of capital. That is why the 180% rise potential is not just a numerical target, but also one of the best examples of technical analysis reflecting market dynamics.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments. Analyze the risks correctly and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.